Let's welcome Feroze Azeez, joint CEO Anand Rathi Wealth as our guest on the show. Welcome to you, Feroze. Good to have you with us. Good morning. Friday morning seems like we're going to be having a softer start, about a 0.4% dip onto the Nifty. The Nifty bank about 0.3% lower. This is all after the entire week has gone in trying to understand and assess the impact of the cash system, the closing auction system, and how we've been seeing the closing of every day's trade happen on a very, very volatile note. Yesterday, it was slightly better off in the first 3 days of the cash implementation. What are you advising clients? I'm sure your phones wouldn't stop ringing to try and understand what exactly is happening in the markets.
Good morning, Sakshi. Like you said, there's been immense amount of uncertainty to closings of the market, especially on Nifty, more so on Nifty than on Sensex. The difference itself exemplifies the reason why this was made. See, on the cash market, auction is actually an auction where a cash market stock is being delivered. Those are real prices. What used to happen is a stock can be traded intraday, and a lot of huge, deep-pocketed people, especially the FIIs, could manipulate the closing price and in turn not manipulate is a strong word, change the derivative closing price. So what they used to do was they used to intentionally sometimes lose money in the cash market to make 5 times the money in the derivative market, because both of them would close at 3:30.
Correct.
And the method was clearly known. So I'm very happy that this has been identified. This volatility itself tells you the need of this system initially. This kind of doctrine could have been possible, and that's what the regulator has been very vigilant. I have met the derivative department in SEBI. We have one of the sharpest group of people. I'm not saying them to please them, and I've interacted with several derivative traders from Cambridge, IIT. Their understanding matches that, if not exceeds that.
Okay, fair point. So I hope that this pans out to be more sorted in the coming days and the coming weeks as well. That's what the market investors are clearly looking at. But there's another breaking news that we are looking at, viewers. This is with respect to Dabur. It's got an US FDA warning now, a letter that flags Dabur's Silvassa plant. The domestic products, the company says, have not been impacted. Dabur also says that there is no financial impact so far. But yes, the issue is limited to private label exports. Remember, this goes on to talk about the same issue that we've been highlighting for you viewers with respect to the 100% organic, 100% natural claims that also the FSSAI has been highlighting for last couple of sessions. And now when it comes to the US FDA is concerned for the Silvassa plant, the domestic products they believe are not impacted, and Dabur says that the issue is limited to the private label exports again. So the stock is just flattish with a negative bias at this point in time. But let me take a quick view from Feroze on the same. Feroze, FMCG stocks largely, not just this particular case in Dabur. What's your understanding post the earnings that have come in? There were a lot of talking points, including the volume growth across the board. And at the same time, what is the outlook after a long drawn underperformance in the sector?
Yes, Sakshi, I think FMCG valuations and the growths don't match. If you look at a lot of top tier FMCG stocks, they have a large weightage in index. That's why the free float has been gobbled up by the index funds. That's why you see valuations which actually can't be substantiated using growth numbers. So I personally am not very bullish. I would see Nifty FMCG index underperforming Nifty over the next 2-3 years by 2-3% compounded.
Okay, let's look at the markets open, viewers. 24,560. 5 at this point in time onto the Nifty. Slightly on the back foot, you can see 0.2% of a weakness coming in onto the Nifty 50. When we talk among the sectors, the Nifty Bank, after yesterday's strong showing, is down by about 0.3%. FMCG, we were discussing, is up by about 0.1%. But IT stocks are again taking the lead. You can see about a 0.6% move there. Autos are moving in the fast lane right at the open. You can see about a 0.4% move on that front. Oil and gas, real estate, those are the key sectors that are up and about. Even metals is showing you some strength at this point in time. On the Nifty, the stocks that are hovering higher again from the IT pack. You have HCL Tech now leading the pack. You also have some insurance companies like SBI Life, HDFC Bank, NTPC that's also up. Let me pull up from the insurance pack LIC that's clearly in focus today. Remember, viewers, about 84% of the analysts covering the company after the earnings have pointed out to a buy rating there. The stocks are to react to its numbers. The profitability has beat the estimates 2% higher at 394 for LIC at this point in time. Let's also look at SBI, which is ahead of its numbers. The street is again expecting that at the end of FY26, SBI had guided for a credit growth to be between 13 to 15%, while NIMs to be higher than 3%. Of course, remains to be seen how the earnings will pan out. It's going into the earnings slightly on the back foot at this point in time, but that's how things are shaping up. But let me go across to Feroze yet again. Feroze, a large part of the earnings season is already out of the way. How have you assessed the earnings that have come in Q1? Have they been largely better than expectations? And post the earnings, where are you already set to give some more earnings upgrades and downgrades?
Yes, so Shakshi, before we get to the broader earnings, if I have to finish the FMCG earnings, which we were discussing, there are about 15 stocks in the FMCG index, out of which 9 had given earnings, about 13% earnings growth. I personally think that now if you go to the broader market earnings, earnings have been better than expected, marginally better than our expectation. We basically look at earnings in two counts. What is my Nifty earnings? Because the entire market revolves around Nifty and plus and minus. That's how we look at it relative to Nifty. The earnings growth for this year for Nifty, we expect a 12% earnings growth on the last year's almost 1,200 rupees of earnings. And I think the quarter one just solidifies that earnings number. That's one. Point two, the broader market earnings have been beautiful. They might end up for the first quarter almost above 20 on both the Nifty small cap 150 and Nifty small cap 250 and Nifty mid cap 150, which implies the broader market rally which has been there in this financial year. Thankfully, the earnings have not disappointed. Otherwise, there could have been large volatilities in the broader market indices.
Okay. Now, also, I wanted to understand from you, Feroze, when it comes to the overall markets, what are you penciling in? Basis the kind of earnings growth that we are looking at, are the valuations justified in the markets, or is more needed to be done to be able to sustain the current valuations?
I think, Sakshi, I would say valuations are very, very reasonable. There are two reasons why. Because 2 years of lull, anytime Nifty delivers 2 years of negative return, which it did in June and May, the next 3 years, Nifty has always delivered positive return every single time for the last 26 years. If 2-year pockets give you negative return, the next 3 years, average return is 20. The maximum return is 52% compounded, and the worst return has been 4. When your courage is not there to invest the market, when you are very disappointed with the market, are the actual periods where you build your portfolios. So are we in that phase? The answer is a big yes. And the second thing which substantiates that, not just a 2-year period, if you look at the last 10 years, the Nifty price has compounded close to 9%. But the earnings have compounded 12.9%. मतलब earnings ने 3% ज़्यादा return दिए compounded. So that has to be caught up in the next 2-3 years. So I would be reasonably bullish from a long-term standpoint. Market volatility and market has still been relatively stable, looking at how global markets are behaving so maverick.
So taking a cue from that, a lot of people would think that, okay, fine, the markets seem to be now starting to go on the turnaround journey. In case I have to start building a portfolio today, what would you advise investors? Where should the fresh money go when it comes to large caps, mid caps, small caps? What exactly is the right mix there?
Yeah, so if you're building your portfolio now, or you already have some portfolio, firstly, have the expectations which are reasonable. Bull markets change their definition as markets evolve. In 10 years back, if I would have said bull market, it could have meant 20% compounded on Nifty. Today, if I say bull market, it means that it will give more than mean return. Median return is 11. So can it get you more than 11 Nifty? Yes, compounded. If that were to happen, what can you create a portfolio? Can you make a 14-15% compounded, doubling your money in 5 years? The answer is yes. What should be the proportions? 55% in mid cap, large cap, and about 25 in mid cap and 20% in small cap. Don't hesitate investing in small cap, because in India, small cap, if invested through a mutual fund, also is a very reasonably large company. It's not a small company with 1,000 crore market cap we are talking about. In the
Yeah.
top 500 is where all the three segments finish. SEBI has clearly told mutual fund guys that in the 500, you have to finish large. Is the first 100 is large, the subsequent 150 is mid, and the last 250 is small cap. But India has got the largest number of listed stocks. The rest of the thousands of stocks are just the tail.
Yeah.
So don't hesitate to have at least 20-25% in small cap. That's not a bad strategy. So this would be the proportion for a fresh investor.
Fantastic. Before we wind up, any key sector or specific stocks that is on your radar that you'd like to highlight to our viewers?
Yes, I think you were discussing pharma. Pharma,
Yeah.
I think, is a good story from a long-term standpoint, because we deal with HNIs who are looking at long-term kind of money. So we look at it relative to Nifty. Over the next 2 years, Nifty Pharma can actually beat Nifty by about 3% to 4% compounded, because there is more upgrades possible on the earnings side than downgrades. There is also the US generic pricing has become more stable. The CDMOs are going to be far more at a multi-year growth phase. So these are my beliefs. So I think pharma could be one sector. The one which is not a very highly penetrated sector is the capital market and its infrastructure. I think that can do well. Like, for example, there's something called the Nifty Capital Market Index. It has about 17 stocks. It has those exchanges, the AMCs, and I have to also give you the disclaimer that RB as a listed stock are also a part of that index. I personally think that will definitely be one sector from a really long-term perspective, because today in Nifty, there is no capital market stock other than banks and financial. This Nifty representation is near zero. If India has to become a big capital market with the financialization which we are looking ahead, I think there will be some representation in Nifty. So if you can pick up those stocks which you believe out of these 17 or the index itself, you will be able to beat Nifty, is my belief.
All right, Feroze, thanks a lot for being with us on the program and guiding all our viewers this morning again. Hope you have a fantastic weekend ahead. We'll, of course, catch up with you very soon on Business Today.